Good. So it's of course hard to be a bear because most of the bears have been disposed of the last couple of months. We've seen some high profile.
Disposed of? That sounds ominous.
Yeah. There's a knock on the door at midnight and you get taken to the woodshed and you never come back. But I still think it's the right thing to do. If you had a list, if you didn't know at all what was going on and you say, I want to have a list to know when I should be bearish, I would say it's when markets are at all-time highs, risk premium at an all-time low, earnings and margins are already as high as they can be. The US macro cycle recovery is in its last innings. The unemployment rate is low, the savings ratio is low, and very ominously, the unemployment rate is starting to tick higher. It's up 70 basis points. Historically, whenever the unemployment rate has started to rise, it has never gone down again. It was always the end of the business cycle, and that means higher risk premium, lower asset prices ahead from very lofty levels. So I say be cautious here.
Why is he wrong?
Sebastian, we meet again. So I would say that we're not really...
Music, doesn't it? They need some dueling pistols or something. Sorry, Hani, carry on.
Yes. I do agree that we are more mature in the cycle at this stage. But what we would say is that the lead-lag relationships of monetary policy are, as taught by Milton Friedman himself, long and variable. So the first thing we would say is they are long. It's only now that we're getting into the zone where you should start to sit up and take notice of what's happening, but not sound the alarm. We're in the equity market phase where what we call exuberance happens. In this phase, you do get most of your turns coming from multiple expansion as opposed to earnings growth. And that tends to make a lot of money managers, a lot of my peers, nervous. But this is the phase where you get the second highest rate of return. You only get a higher rate of return coming out of a recession. And this is the second highest rate of return phase. And it can last, on average, it lasts 2 years. And it can last up to 4 years. It is very dangerous to call the end of that cycle prematurely. And I'll just stop with one final a quote from the legendary Peter Lynch himself, who said, "Far more money has been lost by investors in preparing for a correction, in anticipating a correction, than has been lost in the corrections themselves."
So, Sebastian, you're leaving the party early by the sounds of it, according to Hani. To the point that you just made around the unemployment rate, 4.1% we saw from the United States, there is a view, and this was from Oxford Economics, saying, look, the difference this time round is that there's an increase in the labour supply rather than firings. Doesn't that make a difference?
So Hani and I, we effectively discuss every month, and we're saying there are all these indicators that historically have been absolutely spot on. They've got a 100% hit rate, but are they going to be different this time around? Is it going to be supply-led, and is this basically a false signal that's going to be misfiring for the first time in 70 years? And I say there's a possibility. Maybe the indicators have been the most reliable, no longer work, but the increase in the unemployment rate has been matched by a commensurate increase in initial jobless claims. They're up 15% so far this year. If you match them against one another, it's 1 for 1. If you look at the build-up of long-term unemployed, historically, when you've got an increase year on year in long-term unemployed, you always had a recession. You're seeing that right now. And if you look at the small to medium-sized companies, the hiring intentions of those, they're basically collapsing. And they suggest, A, the increase in the unemployment rate comes from lower hiring intentions, and B, because there's a lead there, there's a lot more to come. And I think what Hani and I, because we only half disagree, what we agree on is if the unemployment rate were to trend higher, and if we see more cracks in the labour market, I think even Hani would change his stance.